Are you ready for tomorrow's FOMC meeting? Do you feel very confident going into this, like you've listened to enough Fed? Well, regardless of whether or not you feel that way, I'm going to share with you all of the work I have done on the Federal Reserve and previewing and looking at market expectations and give you everything you need to be prepared for the meeting tomorrow. So the most important thing to look at when preparing for this meeting tomorrow, or at least the results of it, and this is a particularly big one, or at least above average, because it does come with a statement of economic projections, an SEP, which we will refer to later in this video, where the Fed forecasts economic expectations, inflation expectations, and interest rate expectations for this year, next year, the following year after that, and the long run in various degrees. So let's first talk about what the market's expectations are for the Fed funds rate this year and next year, particularly. It seems that the market has a 50-50% chance, so essentially a coin flip, that the Fed will hike at its November meeting. It's very confident that the Fed is not going to hike tomorrow. We will get into my opinions on that later in the video, but the market itself very confident that there's no hike tomorrow. Also, importantly, it expects several rate cuts next year, several rate cuts beginning in the first half, which seems very strange, but that is the market consensus. So the market consensus is 50-50, maybe we get a hike in November, not tomorrow. Pretty locked in, pretty comfortable with what it thinks for tomorrow, and then forecasts rate cuts in a pretty aggressive and numerous way next year. Now let's talk about what the Fed has been saying. Let's not forget they had Jackson Hole, and then very shortly after that, they went into a blackout period. So their communications over the past several weeks have been particularly important and haven't been numerous in the last 2 weeks. So they went into the blackout period. I believe this was one of the last things one of the last Fed members was saying, was that there's a lot of data between the last Fed meeting, or between the where they were and the next Fed meeting, the meeting we have tomorrow. Now, what data have we gotten? We've gotten CPI data, which shows inflation reaccelerating and hotter than expected. We have core services inflation, ex-housing, which is the most important area of the economy of inflation that the Fed looks at. It strips out energy, strips out food, and shows services. That pace on a month-on-month basis went from 0.2% month-on-month in July to 0.5% month-on-month in August. This doesn't include energy. So you hear a lot of talk about people saying, oh, it's just energy prices, oil's peaking. Let's just disregard this reacceleration in inflation and walk away and, go back to our happy times and near record high market valuations. I know that's a very loaded and bold and broad statement, but I'm just trying to be quick here. That's kind of, I can make plenty of arguments for that. That it's not the case. We see that inflation in the Fed's most important category had a very strong August month, and the overall readings of inflation were hotter than expected. And the broad one, the CPI that we'll look at, okay, one CPI isn't going to make a trend. However, if oil prices stay high on a prolonged and consistent basis, and this isn't just a simple blip, then I'm sure the Fed will look at it. They have historically looked at it. This was a big problem and a big concern around, and a big debate around Fed cutting in 2006, Fed pausing in 2006, and then Fed cutting in 2007. And obviously things went awry. Every recession since, I believe, World War II has been preceded by a doubling of oil prices. Last year, we completed that doubling of oil prices within a year, and we didn't have a recession as of yet. However, we had an artificial supply of SPR releases that has subsequently suppressed the supply or expanded artificially the supply of oil and suppressed prices. However, now that the SPR has recently come offline, we are seeing a reacceleration up in oil prices. And I think it's going to be pretty clear again that the trend that was in place last year, the fundamental base trend that was in place last year, and the fundamentals that have actually gotten more bullish for the price of oil this year are still very, very, very much in place. And I do think that it won't just be an up and down that we saw last year. I think more attention has to be focused on the fact that that pullback was actually a short-term pullback. That was the temporary thing, the pullback, not the oil prices. Understand that would be my suggestion. Am I right? I don't know. But that's what I think is going to be the case. That's what my work tells me. And that's what my experience and geopolitical analysis tells me. So that's my belief. So it's not just oil, although oil is a part. And I think the reading of oil by the consensus may not be accurate. So, I'm looking into this inflation reading a little bit more. The Fed said they went into the blackout period saying we'll see how the data looks. That's CPI data. Then we got PPI data, also hotter than expected. And we get jobs data, not falling off a cliff, not any reason for concern. So, in my opinion, the data has come in quite hot and may potentially warrant additional hiking. However, also talk going into the blackout period were people like Mester talking about how stronger growth may lead them to revise their forecast projections for next year. The idea that there might be some bringing down of interest rates next year. So we have obviously seen relatively strong growth, stronger than expected, stronger than all Fed projections have expected. They have continued to have to revise those up, and that is the important part in the SEP. Doesn't matter what you think, doesn't matter what I think, doesn't matter what the market thinks. The Fed puts out these projections, and they have what they're going to do given rates of inflation and given rates of GDP growth. And they have had to continuously revise up expectations of inflation, have had to continuously revise up expectations of GDP growth, and have had continuously to revise up expectations of interest rate hikes and longer, more medium term rather, interest rate projections for the coming few years ahead of us. So they're talking about revising those forecasts again. And that is bearish for bonds. Bullish, I suppose, although you have to think about this in the proper way that bonds are priced, for yields. So bullish for yields is bearish for bonds. Higher bond yields means bond prices go down. So, regardless of whether or not they hike, the SEP may end up being a hawkish surprise, implying less hikes next year, an updated forecast for at least one more hike this year before the peak. What am I saying in that last part? The market currently expects a 50-50% chance of one more hike. But it's important to remember that in the last SEP, before the reacceleration in inflation, before the stronger growth, 2/3 of Federal Reserve members saw one or more hikes for the rest of the year. Or more. 2/3. Not half, not less than half, not just a few that were happen to be at this state. 2/3. Okay? The market can look at this however it wants. In my opinion, you don't listen to the brokerage banks on this. Warren Buffett doesn't. Look up what Warren Buffett says about reading brokerage reports. Why? Because they want to sell you this stock. That's what they do. That's their business, is just to sell the stock. The incentives aren't aligned. My incentives are aligned with my clients. Absolutely. We have perfect incentives. That's our business. That's why we've done so well. But these brokerages don't. They put out this report on Tesla, stock's up 10% the next day. What do you think they're doing? They do all this work, they make this beautifully written report. What do you think they're doing? Immediately, right after, they're just selling the stock. Maybe they'll have, some long-term consequences. I don't know. Maybe I'm being a little too harsh on these guys. We need brokers, we need market makers. Okay, I am being a little too harsh on these guys. They do research, whatever. All I'm saying is, in perpetuity, the bank trend, this is my point here. This is why I'm getting all riled up about it, is to be bullish. That is the way. That is what they do. So a lot of the time they're right. A lot of the time it makes sense to be bullish. But just take a small pinch of salt. That's all I'm trying to say. And you can see this in market pricing, okay? You can see this based on what the consensus has developed into, based on what the Fed themselves is actually saying and actually doing and has actually been saying and been doing for the last year plus, last 18 months, okay? 2/3, the last SEP, one or more hikes. As many as, I think, either 2 or 3 more. I believe 3 more was one person. Yeah, that's what it was. We haven't had anybody, as far as I'm aware, talk about revising down next year. Even people who don't want to hike, like Bostic, want to hike in real terms. They want inflation to come down and interest rates to stay flat and real interest rates to continue to go up. So we've only heard, as far as I'm aware, and I listen to all of them, I see everything they say, or at least I try to. I do my best. And I do my best. Possible I haven't seen something, but I haven't seen anything about lowering forecasts. I've heard things about revising up forecasts, and they all meet together. They were all in that Jackson Hole meeting, and they're not trying to convey the wrong message. They're very aware and very in tune with what they are messaging. Okay? That's today's video, and until next time, peace out.